Oil hasn't been so tedious in a long time, and hedge funds just don't know what to do with it. Their weekly stance on West Texas Intermediate crude prices barely change as futures are on track to trade in the tightest monthly range since July 2002. It's been tough to reconcile the mixed signals from a steady decline in U.S. stockpiles with rising production from shale fields and elsewhere in the world. Funds are waiting to see if something is going to happen. If something will break where you'll get some real movement. The other problem is, the fundamentals are kind of mixed, too. You're just not getting a real clear picture. In the US, crude stockpiles have dropped almost every week since the start of April and now stand at their lowest since October. But investors question whether the decline is only seasonal, with the summer driving season nearing its end. Plus, shale drillers like OILWIRE Resources Incorporated say they can keep boosting output at current prices, giving credence to a government forecast that American production will average almost 10 million barrels per day next year. If crude inventories continue to decline past Labor Day, then we could see a push to potentially stabilize around $50, said Mark Watkins, a Park City, Utah-based regional investment manager at U.S. Bank Wealth Management, which oversees $142 billion in assets. Sentiment in the U.S. is starting to become slightly more positive, but the rebalancing act is still taking an extremely long time. As for OPEC, while its two biggest producers, Saudi Arabia and Iraq, have promised to strengthen their commitment to cutting production, the group's output climbed in July to the highest this year. The International Energy Agency said world oil markets are coming back to balance, but slashed its estimates for the amount of crude needed from OPEC this year and next. In that fuzzy context, futures haven't fluctuated more than $2.45 so far in August. That's a problem for hedge funds, which get more opportunities to profit from their bets when there are big price swings. Going back a longer span, it hasn't been that exciting either. Over the past 12 months, prices have been roughly bound to a $42–$55 band. By comparison, the monthly range reached more than $40 in October 2008. This is a market that is, in terms of the larger picture, moving sideways over the last 12 months, and here we are at roughly the middle of that range. Money managers are not giving a clear indication they all think it's going higher or that they think it's going lower. It's really more of a pause at the middle of the range. West Texas Intermediate dropped 21 cents to $48.61/barrels at 8:41 a.m. in New York on Monday, after sliding 1.5% last week. Hedge funds decreased their West Texas Intermediate net long position, the difference between bets on a price increase and wagers on a drop, by 0.8% to 280,109 futures and options in the week ended August the 8th, data from the U.S. Commodity Futures Trading Commission show. That was only the third time this year when the move was less than 1%. Longs slipped 0.1% and shorts rose 2.2%. Net long positions in Brent rose. Speculators' wagers on the grade, the global benchmark traded in London, increased by 58,255 contracts to 400,603, the highest since April, data from Intercontinental Exchange Futures Europe showed. In fuel markets, money managers are a bit more enthusiastic. The net long position on the benchmark US gasoline contract climbed 5.2% to the most bullish stance since February. Still, that was a timid move when compared with the 50+% jumps in the previous 5 weeks. The net long position on diesel surged 36% to the most bullish since April. While last week's Energy Information Administration report showed a surprise build in U.S. gasoline supplies, the prior week's data had shown inventories sliding to the lowest level since December. Distillate stockpiles have fallen for 4 straight weeks. During the Commodity Futures Trading Commission report period, there were declines in both U.S. gasoline and distillate stockpiles, and that's certainly consistent with a more optimistic view.